Critical investor trade alert. Prepare for hyperinflation in food and energy costs in 2022, the longer this war with Russia and Ukraine continues. The global elite have forced Putin to flatten Ukraine in the coming weeks. I anticipate things will get very ugly over the next 14 days and lead to diplomacy, which will eventually create a massive melt up in stocks, bonds, and cryptocurrencies. Today, though, we're looking at a meltdown in all assets. No matter what you're in, stocks, bonds, cryptocurrencies, or the dollar, they're all down. And it's because of inflation. Inflation creates big problems for central banks. Now, headlines today, critical Fed interest rate meeting on Wednesday. I believe it's going to be more of a dovish surprise. We might get a nice bounce on Wednesday. We're not going to be hosting a webinar Wednesday, so I can listen carefully to Powell's speech and potentially deliver a trade alert on Wednesday, which would most likely be a bullish related trade alert if we were to make a trade. Meanwhile, US and China are having a meeting today, and US has been threatening China to not support Russia. And again, China responded to this by locking down Shenzhen and an Apple factory, showing them if you mess with us, we can completely cut off your supply chains. So this either ends in 2 weeks, I'm expecting, with a diplomacy, Ukraine surrenders essentially, or Russia teams up with China, and China starts cutting off supply chains to the US starts messing around with China, and this could quickly get much, much worse. Meanwhile, the Russian currencies collapsed, the Russian stock markets collapsed, so they're basically all in at this point. So I'm afraid the worst of this war is coming soon. And again, it could be over in a few more weeks if Ukraine surrenders, or this escalates and we create World War III. So very interesting time period. It's critical you own 2 stocks to protect your wealth right now. And again, our advisory is up 4% in 2022, while most investors are getting slaughtered. You're likely down at least 10% or more with the traditional stock bond portfolio. Now, this strategy did deliver a 233% return in 2021, and much of the gains happened in only a handful of months. You got to have your portfolio position to catch the big gains to the upside. So let's review a $10,000 trade alert following our program. Now, again, if you had $20,000, double it. If you had $100,000, multiply by 10. Step 1, buy some stock crash insurance, okay, with mainly commodities, futures markets going limit up, limit down, back and forth, acting like a penny stock. You need to have the stock crash insurance. So the main threat that's not priced into the market now is essentially an escalation with China screwing with US supply chains. That's really not priced in yet, and what I think could take markets significantly lower. If we just have Russia and Ukraine battle it out without an escalation in Europe, we could very well likely be at the bottom of the equity sell-off by Wednesday, get a dovish surprise from the Fed, and then again get Ukraine to surrender, and things should really tame down and get a nice melt up in markets. So 88 shares of UVXY protects you against unpriced market risks that could take the market much lower. I think it's a low likelihood, but we are holding on until the de-escalation occurs. And unfortunately, de-escalation is nowhere near sight at this point. So UVXY did go up 11 times in 2020. So a 10% position does the trick. If you get a massive crash like you had in March of 2020, where the S&P 500 went down 34%. So at this point, we're way over 10%. We're closer to 18% in this hedge. And I do want to dump that position down as soon as possible and buy the dip into stocks, cryptocurrencies, and maybe commodities, depending on how low oil goes. But I'd like to see oil hit about 80 to go back long that. Now, our product protecting us against this volatility is up over 69% year to date. And that's a chart of it to date. It could go skyrocketing to the upside if we were to, again, have another capitulation moment and freak out markets even more than they are. So UVXY is the first ETF you want to pick up. And again, 88 shares per $10,000 you're investing. Step 2, go long growth assets. Okay, so as soon as the de-escalation occurs, we're going to expect essentially technology stocks to skyrocket and outperform. So I've got ETHE as our best long-term pick. This is Ethereum. It's replacing the whole financial system in a decentralized manner. And what we've seen over the last year is a massive advertisement to be long this asset. But I also have another trade I'm very excited to put into the high risk portfolio. It's most likely going to be FNGU. I want to get the leverage play in some of these big tech giants that have been beat up. Specifically, very bullish on Facebook, down 50%, and Alibaba back to IPO prices. So that's a play I'm very excited to add into the mix. Now that it's clear we can't buy the Russian stock index anytime soon for the high risk portfolio. So again, we're not pulling that trigger just yet. We need to pull profits off of UVXY and Boyle before we do that. We're not going to make that move until we get through the energy crisis. So here's a look at Ethereum over the last 5 years, up 19,000%, and that's after about a 45% decline from the top. 50% volatility in cryptocurrencies is very normal, and this is typically one of the best opportunities to go along these assets. Now, the play we like is with ETHE. You're actually going to pick up Ethereum at about a 25% discount by owning ETHE instead of the real Ethereum. Last step is to buy 99 shares of Boyle. This is really the asset that markets have, that the sanctions have not touched. So we have not touched the flow of natural gas to Europe from Russia because it would be devastating to Europe. So either we try to put this war to bed by cutting off all exports from Russia and put a lot of pain into Europe and energy costs go skyrocketing, or we potentially have Europe trying to reroute orders, which they're currently doing, which would drive up the value of Boyle. So this is your inflation energy hedge that makes the most sense right now and is really the last sanction that has not really been imposed heavily that could cause a lot of pain to both Russia and Europe if they were to start blocking the Nord Stream pipeline from Russia to Germany. Just look at that chart. This thing could go much higher, trading at about $39 right now. Just a few weeks ago, we had it hit 55. Last year, before all this mess was developing, we've seen it trade at 90. But again, if this were to be cut off, this could skyrocket to the upside. We want to hold this until the war with Russia and Ukraine is resolved. And so far, that's nowhere near occurring. So if you look at the table breakdown, it's again 88 shares of UVXY. That's your crash insurance for the stock market. We've got 221 shares of Ethereum with ETHE. And then we're picking up 99 shares of Boyle. Okay, so you've got your inflation hedge with Boyle. You've got your growth position long-term with Ethereum. And we've got our stock crash insurance play with UVXY. Okay, so that's these three put together makes a beautiful portfolio. Now, soon we're going to reduce UVXY. We're going to dump probably most or all of Boyle. And we're going to add to ETHE. We're probably going to add FNGU. We may short oil with DRIP. And we're also going to wait for the price of oil to get to an affordable level and go back long in our geo. So I'm looking for a pullback in oil into the $75 to $80 range, and then ride it right back into the hundreds. So again, we did sell in our geo a little too early. We've been doing decently with Boyle, but the potential for a just massive return in an escalation of war is definitely with Boyle at this point. So we're remaining long that position. Now, again, if a de-escalation is in the cards, energy costs could sell off rapidly, causing bond yields to fall. Bond yields just got knocked the wind out of them today. All three critical bond markets are selling off today. The TLT down 2.1%, below a very critical level. So 134 in the TLT was critical. We've burst through that. So I'm not going to touch those bonds yet, but they are getting closer to a attractive level and could become a position sooner than later if this type of volatility continues in the bond market. I don't think it's going to happen, but very interesting. And we'll see how the what we're expecting to be a 25 basis point rate hike does to markets on Wednesday in terms of the bond market. Now, oil above 100 for over 6 months will likely crash the economy itself and does act as a tightening vehicle for the Fed to potentially let them not be so hawkish on their end. Now, if we look at this chart, you can see when oil goes over 100 for a long period of time, doesn't take long until you get an absolute collapse in oil prices. So drip to short oil is an exciting play that also aligns with being long Ethereum. So we're looking at that opportunity. And again, today we have oil down, we have bonds down, we have stocks down, we have crypto down, we have all three bond markets down. So very unusual moves today. And the dollar's down. So there's that level we were looking at on the TLT. It's now below it. So at this point, the best decision is to sit back, ignore the volatility, and wait for the macro environment to be easier to predict, which again is how long are energy costs going to remain elevated, which is all due to when the heck is this Ukraine-Russia war going to end. Now, again, if we do get falling bond yields, which I believe is the most likely case for the remainder of the year, it's likely to moonshot cryptocurrencies and tech. And so I like Alibaba, I like Ethereum as two main plays to get very aggressive with. And there's other tech companies obviously trading at very attractive prices. Now, the last time the US tightened while China expanded credit, Bitcoin returned 4,400%. So I think it's important to note that there's a lot of problems developing in China's real estate markets, bond markets, and its tech companies. They're also still doing a lockdown policy due to COVID. And I believe they have locked down their Shenzhen and Foxconn factory, not because necessarily there's really an outbreak, but because it's a warning to the US to not interfere with China's interest in buying up Russian commodities at a 20% discount. So that's quite likely why we're getting those headlines today. But in general, if the US is going to hike rates every meeting, which is what the bond market's saying they will do, we got to expect bond yields to rise in general over this period of time and force investors into alternative assets. So they're now talking about essentially about an interest rate hike at every meeting this year, plus letting the balance sheet run off by $1 trillion this year and next year, which probably is not going to be pulled off. It's most likely just positioning to try to fight inflation with talk. But the last time this happened was when Trump went into office, 2016 to 2018. China had to print money and bail out its economy after its real estate market had, guess what, nearly collapsed in 2015. And meanwhile, the US went into a tightening cycle, and you got this amazing 4,400% return in Bitcoin. There's the chart. Now, the catch is, if you know this chart well, Bitcoin hit 20,000, but it wasn't much later that it crashed some 80%. And that's because the bond market became attractive relative to inflation and created a black hole that destructed assets all around it. And it wasn't soon that we were back into a period of QE. So at this point, we have governments running big deficits. This makes cash lose value relative to things you buy. And we're seeing that in inflation. Bonds are still garbage. We're running at a 7% inflation rate, probably going to run up to 8% before we hit a peak. And interest rates sit at very low levels relative to inflation. So we've still got the 30-year Treasury only paying off 2.48% a year compared to a 7% inflation rate. So again, I'm expecting inflation to peak and fall, and probably a little more pain in bonds before we get that magic moment to go bullish on bonds. For now, bonds are still a bad bet, and they continue to get hit week after week, causing more and more pain in markets. So if you look at your options, there's still no other logical option. We're anticipating a stock, crypto, commodity melt up over the next 12 to 24 months until bonds become attractive again. And so I do think we're very, very close to the bottom in the pain in stocks and cryptocurrencies. And we just need to carefully wait for the next few weeks to transpire, cut our hedges, and go long growth assets to close out the year. So again, the bond market's not going to be super attractive until inflation's falling towards the interest rate on yields. And so that could start to happen, but it's not going to happen until China stops locking down supply chains and Russia is allowed to freely sell its energy without sanctions. So these two things must occur for inflation to cool off. So it's critical you watch our webinar every Monday, Wednesday, Friday. Note there will be no webinar Wednesday. Be on alert for a trade alert. Okay, so we'll be potentially doing a trade alert Wednesday, most likely not, but maybe. And again, be ready for our sell alerts. Now, if you have any questions or you'd like to customize trade alert, email Dean or call Dean at 505-322-7515. That's 505-322-7515. Let's see. Pat says, what's the chance US delists Alibaba? 0. Okay, so that's our current question. Okay, great. So let me go ahead and jump into today's data and news feed. U.S. National Security Advisor Sullivan warned China that it would absolutely face consequences if it helped Russia evade sweeping sanctions over the war in Ukraine. Spokesperson for the U.S. Embassy in the United States, Louis Pingwu, told CNN he had never heard of the request from Russia for arms. Fourth worst start to a calendar year for the S&P 500 ever, down 11.8% in the first 48 trading days. Here's what happens next the other times. And so 48% return after the 2009 decline. Now we already sold off for much of 2008. 2020, we ended up with a 15% decline, returning 37%, 1935. You got a 64% return. 2022, we don't know, 1933. After an 11% decline, you had a 62% return. In general, right now would be the worst time ever to sell stocks. We want to get ready to sell our hedges and buy the dip at the right moment. And I think we're approaching that. Another data point similar at 1,115 days, the NASDAQ is 3 days away from being its longest correction since the financial crisis. We bottomed right around this point during the 23.6% drop in Q4 of 2018. So looking at the NASDAQ's drawdowns, and in terms of days, we're 2 days away from the longest yet. And again, the bond market's likely going to have to stop crashing before the NASDAQ does. US options still on the table toward Russia include full trade embargo, blocking access to international waterways, Prohibitions on nickel, uranium, titanium, and Russian entity crypto assets, CNB reporter on Twitter, citing Janet Yellen, Secretary of the Treasury. Interesting perspective. Weak consumer confidence can only get better and trigger an equities rally from JP Morgan. So consumer sentiments at very low levels, primarily due to inflation, which again, we're really in the game of predicting inflation at this point. Alf, recently I showed the 12% year-to-date decline was the second worst performance seen over the last 123 years. But how did equity markets historically perform after a 10% loss or more in the first 2 months? Massive rallies in 75% of the cases. Only in 2008, the shit got a lot worse. And again, we really have depending on what China does, what Russia does, and what sanctions we put on, this either could get way worse or this could be resolved and we get a big market rally. So we're carefully monitoring when to sell the hedge and add to the longs. Goldman Sachs reforecast 7 rate hikes of 25 basis points this year, followed by 4 more next year to bring the terminal rate back to 2.7 to 3%. So I'm not so sure they're going to pull that off, but that's kind of the interest rate I wanted to see the 30-year hit. So if we get a 2.5% interest rate on the 10-year, I will absolutely get us very bullish in bonds, as I don't think the 300 trillion in debt globally can be sustained at an interest rate higher than that. Why is oil down a little bit? Yeah, it looks like Venezuela is going to step up some oil production. And we're seeing Russia slowly but surely find players who will buy their oil at a 20% discount. So unless Nato goes and starts to attack those countries, picking that up, which is India and apparently China, which would again really create a massive problem. That's the reason why we're seeing a little bit of a cool off in oil. And again, that's why we want to short oil the second this de-escalates down to the 75 to 80 range. And then we'll flip the play into NRGO. The US sent diplomatic cables to allies in NATO, Asia, saying China had shown willingness to supply Russia with military and economic assistance. US State Department says we will ensure that no country is able to get away with trying to bail out Russia. Just in, large-scale cyber attack against Israel. Government websites are down, including the National Cybersecurity Authority. Russia is actually offering, not a 20% discount, 30% discount on oil. Santiago Capital says if Russian countermeasures against US were to lead to the dollar losing 50% of its value, the S&P 500 falling 50%, and the US implementing capital controls and the already high US inflation prints doubling overnight, would you consider this a victory for Putin or Russia? So he's pointing out that the US has much more to lose than Russia does if this goes on for long. We got surging cases in Germany and China, although US seems to have completely forgotten about all this. Elon Musk last night challenges Putin to a one-on-one duel with the prize being Ukraine. Some comic relief. Okay, we're seeing a bunch of countries ditch the dollar to trade directly with Russia. So we got Belarus and India so far, and apparently also China, although it's not super clear. Essentially, getting rid of the euro dollar and trading in their own currencies. So all of this is going to make China's currency much stronger in the long run, and potentially Russia's as well. U.S. State Department says Sullivan has raised directly and very clearly our concerns about China's support to Russia in the wake of the invasion. Spot Gamma, a options expert and YouTube channel, says the 1 month realized volume of volatility shown here, it really has been a slow boil, no real jump or moment of market capitulation yet. So The rate of change in the VIX has been steady. We've basically had a nice, slow, orderly decline in the S&P 500, not a limit down type of day. And that's what would really make the VIX or UVXY skyrocket, would be a complete panic limit down day. There's no way to protect your portfolio against a slow pace sink without the bond market correcting first. Oil drops on reports. Chevron set to start trading. And that was a question from Marissa. But the market's not really wired that way. It's going to slingshot back up soon as the volatility index falls. So we need to time selling the VIX, being grateful for what support it gave to our portfolio, and then sit back and go long the assets that make sense. That's really our plan. And I think we're going to end up this year with a really, really nice return, as I do think that the pain that Europe, the US, and Russia is willing to take is going to essentially end probably this month. Oil drops on reports. Chevron set to start trading Venezuelan oil once the US relaxes sanctions. US tells allies China signaled openness to provide Russia with military support. Albert from Live Monitor says this weird market action is making me think Fed is going to surprise dovish. And I think all they really need to do about that is not be so clear about when they're going to let the balance sheet run off, and maybe be more quote unquote data dependent and believe that the inflation will come down as soon as the war ends and the supply chain issues. So we'll have to see how they play it. They could come out extra hawkish too. The whales keep buying up the crypto and taking it off exchanges. 54,000 Bitcoin taken off exchanges in the last 9 days. This is just a little note from Matt Taibbi saying that making fun of Americans who are all about the wearing your mask, taking your shot, locking down. And now they've completely forgotten about that, and they're all in on let's fight a war against Russia for Ukraine, about how they can forget things so quickly. And we actually had Elon Musk making fun of that as well with some memes. China's been locking down a bunch of different cities, saying it's because of the COVID. I believe this is probably more a threat to the US, to make it very clear we really can't stop them from doing anything without a lot of pain to ourselves. So we will see exactly how that meeting ends up. Some FUD about the VIX. Barclays pulls a Citadel Robinhood this morning. They stopped creating shares of VXX or oil. Breaking products they've taken fees on for years, while having the gall to say it's not related to market conditions. But he does have a good note about the one we're in, UVXY. ProShares ETFs, UVXY, are a pooled trust, which should be better than Barclays ETNs, which are backed by Barclays themselves. So again, we're currently in UVXY. And also, if we did want to try to short volatility, that'd be very similar to shorting oil with drip. So, but again, we're just going to basically stay positioned how we are until the war is diplomatically resolved. And so it's very hard to tell. Is this going to blow out into World War III, or is Russia going to give up? Highly unlikely. Or is Ukraine going to surrender? And I think that's most likely outcome at this point. Russia could take full control of major Ukraine cities and has sufficient military clout to fulfill all of its aims in Ukraine without any need for help from China, the Kremlin said. Russian troops could take major population centers under full control. Kazakhstan bans taking more than $10,000 of cash out of the country. More advertisements for crypto. The butchering of China names is obscene. U.S. institutions have no more than 400 billion of China's stock after last week. Zero Hedge says, was the Shenzhen lockdown and sudden COVID spike part of the Putin-Xi negotiations? Here is Elon making fun of your typical American who just watches mainstream TV. I support the current thing. Russia threatens to ban YouTube if Google does not respond to its request to lift the ban on its YouTube media channels. Big game of chicken. Can the West outlast Russia and China if commodities and factories are shut down? Doubtful with the run up to elections. So don't forget we have midterms in November. Very, very likely all this chaos is simmered down in the next 30 days or less. So we're trying to time selling BOIL and UVX and then reallocating that capital. Germany said an immediate boycott of Russian gas and oil supplies could hurt its own population more than Putin, bringing mass unemployment and poverty. 55% of their natural gas, 52% of its coal, and 35% of its mineral oil comes from Russia. China demands full account of U.S. biomilitary activities in Ukraine. So we've had Mark Rubio and Ukraine and Russia saying that the other is going to have a false flag chemical attack to escalate the war. Supply chain issues are only getting worse given what is happening in Russia and China. I thought after the Olympics, China would loosen their COVID restrictions, but it looks like they're still trying to fight it. Maybe they're just using that as muscle in these negotiations. Communist China seems well positioned to buy up depressed Russian assets and take control of big sectors of the country. China locked down to warn US not to follow Russia's strategy versus Beijing. No coincidence, SEC made that delisting threat, and now China uses lockdowns as a counter threat. Berkshire Hathaway has purchased $6 billion of Occidental Petroleum. We've really moved from haha, nothing bad can ever happen, buy stocks. That was last year. The Fed has your back to laugh out loud, nothing good can ever happen. Sell stocks, the world is ending. Much faster than I thought possible. It feels much worse, but the S&P 500's 13% max drawdown this year is right in line with the median intra-year drawdown since 1928 at negative 13%. China may cut RRR and interest rates to stabilize growth. 300 billion of Russian gold and forex reserves have been frozen. Whoa, Bank of America is forecasting US inflation will be higher in 2022, 7%, than in 2021, 6.7%. Robert Barnes says, well, here's the first quote. We need to humiliate Russia, devalue its currency, and cause hyperinflation so it does not become Nazi Germany. Robert Barnes says, irony is the number of people retweeting this who don't see the irony. So after World War I, the Europeans did massive reparations on Germany and caused it to go into hyperinflation, create new currencies, devastate the economy, and then it turned into Nazi Germany because of all that pain. The drop in the NASDAQ Golden Dragon, China's index, is about to surpass the 2008 round. So yeah, it's been a painful period to be long our emerging market position. But with the situation we're setting up, I want to add to those positions, and I do think we're going to make the most on that. Mike says, how do you short a stock? Buying puts? No, that's not the same. But we will buy drip to short oil. We can short UVXY with another ETF. if we wanted to do that. Say whatever you want about the waning influence of the American empire, but the simple fact remains that it just coordinated the largest and most severe non-wartime list of sanctions against an individual country in modern history. Seems the old dog can still draw a crowd. But was it worth it? That's what we will be having to calculate once the dust settles here. I would suspect no. This guy's joking. I guess Russia lost the war already. Twitter military strategist said so. I don't think Russia's going to lose this war with Ukraine. Goldman Sachs slashes 12-month valuation multiples for Chinese stocks from 12 times to 12 times from 14. This even as China continues to cut rates and ease. Let's see, Elon Musk had some posts about inflation, saying Tesla was feeling a lot of inflation. What do you guys think it will be? Sivan Henrik writes, demographic reality of negative working age population growth suggests long-term inflation will come back down to or below 2%. Recent inflation driven by 2020-21 monetary and fiscal stimulus excess, supply bottlenecks, and exacerbated energy costs through the Ukraine war are causing this short-term spike in inflation. I do believe that's the case, which is critical for how we're positioning our portfolio. Until the Ukraine crisis, I was not worried about inflation this year. Labor supply is increasing quickly, and that will ease labor shortages and supply chain issues. The durable goods boom can't last forever and will likely lead to durable goods weakness for a time. Now I'm worried we are having supply shocks piled on top of supply shocks. But let me talk about some things I would call equilibrating forces pushing back against the inflationary pressures. While energy shocks might not, in theory, be inflationary, as less spending happens elsewhere, as the leading energy and time series economist in the world argues, in practice, it often takes unusual events to cause the prices of many goods and services to actually fall. Sorry, let me find that thing. The other factor is that labor supply is increasing quickly. There aren't many things left to hold labor supply back now. One of them may be pent-up savings, but the inflation and high energy prices we are seeing are eroding those savings even faster. Increases in labor supply should help address supply shortages and reduce intense wage pressures from acute labor shortages. Both good news for reducing inflationary pressures. These are reasons to worry relatively less, yet the energy price shock is very large and very worrying, not to mention other new supply disruptions from the crisis in the Ukraine. So, even given these factors I'm laying out, it's still a lot to worry about. The most important thing now is that the administration give the Fed less reason to panic and hike rates because we still aren't recovered. These are supply shocks we would normally look through. It is just hard to do that when inflation is 7%. The administration should basically do whatever it takes to supercharge fracking right now. And that's not happening. And his team has laid out they could be making purchase commitments in the future. They could also buy frackers, collared hedges, guaranteeing a future price. Whatever they do, they should do it big and do it soon, and stop trying to win the messaging war with short-sighted attacks on profit margins. So again, we'll see if they make that move. It goes on and on, essentially laying out the case for deflation over the course of the year, but with one big catch: these energy costs have to go down, which I completely agree with. And so far, we're not really seeing anything except trying to open up to some other communist regimes to increase output that were previously sanctioned, like Iran and Venezuela. There's nothing for China to gain in supporting the US position, but by helping Russia against Ukraine, China knows that Moscow will keep the US busy in Europe and thus will shift its attention away from the Indo-Pacific and the South China Sea. Albert says China's most valuable market is the US. It cannot risk what happened to Russia. Their actions are in preparation to get Sullivan and the US off guard going into talks. They'll strike a trade deal and Russia will be left out in purgatory. The Hang Seng Hong Kong index down 7%, limit down last morning. Russian naval forces established a blockade on Ukraine's Black Sea coast, says the British Ministry of Defense. Foxconn suspends output at China headquarters. Luke Roman says nothing is going to replace the USD. This is a common straw man argument. The new system is commodities priced in USD, the euro, the yuan, with imbalances netted against other trade, than any net settled as central bank gold. Jeffrey Gunlack, the American people think the reason for inflation is government spending. The government spending more, simply not true. This was a quote from, I think, Pelosi, I think Pelosi said that. And so Jeffrey Gunlack says, which is it? A, the highest level of government is clueless when it comes to economics, or B, the highest level of government is lying. Quote unquote, I'm sick of this stuff. Elon Musk, what are your thoughts about probable inflation rate over the next few years? Tesla is seeing significant recent inflationary pressures in raw materials and logistics. Michael Saylor, a big Bitcoin guy, says, owner of MicroStrategy, USD consumer inflation will continue near all-time highs, and asset inflation will run at double the rate of consumer inflation. Weaker currencies will collapse, and the flight of capital from cash, debt, and value stocks to scarce property like Bitcoin will intensify. Elon Musk says it's not entirely unpredictable that you would reach that conclusion. As a general principle, for those looking for advice from this thread, it is generally better to own physical things like a home or stock in companies you think make good products than dollars when inflation is high. I still own and won't sell my Bitcoin, Ethereum, or Dogecoin. Kobisi letter says the SPY bull market cannot continue until crude oil goes below 100. 150 basis point swings in the SPY's daily stop. There is a Russian ED of my strategy, the logic of war and peace. Putin needs a copy. That logic is always paradoxical. He attacked because NATO was so weak, but his war is impairing NATO ×3 or ×4. He attacked Ukraine because he thought its identity was weak, making it very strong. Morgan Stanley says we continue to believe that the share of Chinese yuan in global forex reserves could reach 5 to 10% by 2030 at the expense of other reserve currencies. That seems to be really what's going to come of all this. Hearing rumors of a possible ceasefire in the next few days. If that happens, oil has potential massive downside due to Fed rate hikes and global meltdown. Looking at the potential crash in crude is what they're looking at. So he's looking for about a $77, $75 oil. I'm looking at how overbought it is a few times in history, and shortly after you got these massive meltdowns. Some harsh realities are about to come home to roost in Ukraine. War is all about logistics. You can't fight if you don't have food, water, fuel, and ammunition. People say Ukraine enjoys the advantage of interior lines of communication. This is true to a point. Interior lines only help if you have material that can be transported or the means to transport those materials. Russia has destroyed Ukraine's fuel and ammunition dumps and their logistical hubs. Russia is destroying Ukraine's supply convoys. Ukraine is running on empty. When was the last time Ukraine maneuver units resupplied? No fuel means tanks can't move. Tanks can't move, they die. No ammo means artillery can't shoot. No food and water means men can't fight. Logistics wins wars. Ukrainian logistics are no longer functioning. The Russian negotiation team has stated that there's been significant developments in talks between Ukrainian and Russian governments, and that they expect a ceasefire to be signed by the two countries in the next 2 to 3 days. One of the Ukrainian security intercepts had a Russian soldier near Kiev telling his family that he was being cycled out on March 14th. Note that cycled out means new forces are coming to replace him. A ceasefire only means they're replacing forces prior to an assault into Kiev, in my opinion. Okay, then we got some rockets from Iran. And so, all right, that's really the state of where we're at. So again, we just need to be patient, wait for the war to end, dump UVXY and Boyle, and buy Ethereum, Bitcoin, Alibaba, just to really sum it up into a really concise strategy here. We can short oil, we can short the VIX, but that's the big picture of what I see playing out. The alternative is China joins Russia, US starts trying to do the same things to Russia that we've to China that we've done to Russia, and all hell breaks loose. So need to be patient. Here's a look at these bond markets going up. So 2-year is at 1.86, the 10-year is at 2.1, and the 30-year is at 2.47. I highly doubt the 30-year interest rate can go above 3 without crashing everything around it. So we're getting closer to a moment in time where if we see interest rates falling and bond yields starting to top off around that 3% range, that I would get bullish on bonds. But with inflation this high and no signs of it falling in the near term, still too early to go long bonds. Here's the yield curve, the 2 against the 10, heading towards an inversion. If we go zoom out, typically an inversion occurs and then a steepening, and then you get a crash. So if we invert the yield curve, it's about a 12 to 16 month delay before you get a crash, and usually the crash is because of the long end of the bond market going straight up, causing problems. So we're nowhere near the bond market signaling a stock crash. In fact, quite the opposite. Most likely Wednesday, we're going to see a 25 basis point hike, not a 50 basis point. Here's the VIX futures term structure in backwardation. So good setup for us to make money if we get some limit down days with the VIX. Here's a look at our favorite cryptocurrencies. We like Bitcoin, Ethereum, and we have a private equity offering that's only available to our paid members, where you're going to get exposure to Polygon. Polygon's much more aggressive play. If I zoom out a bit, we can see Polygon since 2021 has gone up as much as 15,000%. It's lost over half its value, and that's our favorite play for big gains to close out the year. If we look at this time range, we can see that Bitcoin and Ethereum have been trading highly correlated and with a slight outperformance in Polygon. And so again, these are our 3 favorite assets over this decade to find growth, massive growth opportunity. And our high risk strategy is all about protecting your Ethereum position to be able to hold it for this. The next 2 decades is really how long I believe it will take to really saturate the market. And right now, crypto is growing faster than the internet has. Okay, so reverse repos at $1.6 trillion. So this is the QE buffer. Here's a look at 3 energy plays: NRGU, USO, and Boyle. So USO and Boyle are playing spot prices on oil and US natural gas. NRGU is a 3-time leverage play on big US oil gas companies. And so far, NRGU has done the best. Boyle and USO are about even. And at this point, if we're going to really escalate and start to embargo energy products from Russia, then the one that really hasn't skyrocketed up yet is Boyle. Oil's still over 100, peaked out at 137, but I think the real pain could be from natural gas getting cut off. In this chart, we're comparing lumber futures to oil. Got a sell-off in both. Today, just about everything's down. Gold, silver, the dollar. Big picture, though, we're interested in a crash in lumber futures to try to predict deflation, essentially, in energy costs. And so at this point, these markets are being manipulated by sanctions. So I'm more interested in when the sanctions are going to end to predict a crash in energy costs. Here's gold versus silver, or excuse me, copper. Gold's outperforming copper, which is predicting a lower yield environment. Although today we got much higher yields. If we zoom in here to a shorter time frame, gold's still outperforming copper, predicting lower yields. Okay, here's the yellow line representing interest rates, the green line representing oil and gas companies in the US times 3, and then the NASDAQ in candlestick. And so we've got over this last 5 days, interest rates rocketing up, oil down, and the NASDAQ down. So very unusual moves today. Here's a zoomed out photo of emerging markets. So the decline has been very, very painful. If I go to this point, 27% decline from the top in emerging markets. I do believe this is very close to bottoming out and outperforming US markets. So at this point, again, I know everybody doesn't like this decline. We had Russia get removed from the index. We've got lockdowns in Asia, and now we have supply chain energy disruptions, all of which I believe will be resolved over this year as China starts to print massive amounts of money and Europe's forced to expand debt and extend QE. So I find the opportunity for Europe and emerging markets to be much greater than the US markets over the next several years. This chart, we're looking at the Russell 2000 for any kind of warning signs. It had been trading in this channel for an entire year and then dropped to a much lower channel. And so it's still trading in this range with no new signal, but we're not currently positioned in Russell 2000. The only index up today was the European index, funny enough. So with the SPY closing down 0.73, the NASDAQ down nearly 2%, emerging markets down 2.4, EFA was actually up 0.9%, which we have exposure to in our safe growth strategy. Here's a look at the DXY. And again, really what's developing is not bullish for the dollar in the long run. Whenever you create volatility, people sell into the dollar. But what we're pushing for with Russia, Ukraine is to get a lot of people trading commodities without using the dollar. We're running massive deficits, both trade deficits and fiscal deficits. So my expectation is as the volatility simmers down, that we're going to see the dollar fall to the 90 range. And that'll be probably when we get peak interest rates and want to go long bonds. Chinese currency still very strong. A little bit of a sell-off today against the dollar, but overall, since the lockdowns, the Chinese currency has gained lots of strength, so they could really afford to print some money, stabilize their markets, their real estate market, and their stock market. And again, that would be very bullish for emerging markets. Here's this big drop in Alibaba and Tencent underperforming Taiwan Semiconductors. So we've been waiting for the opposite to occur. If I look at this, you can get Alibaba at 70% off from a year and a month ago. Tencent 53%, and Taiwan Semiconductor down 25%. So again, I think this is where we're going to see the greatest returns is with EDC over this next cycle. And I know it's been a painful hold, but my next move is more likely to add to that position than subtract. Here's Toyota with a big sell-off. The semiconductors are going to be disrupted the longer this goes on with Russia. An element neon, apparently 50% of the production comes out of Russia. And again, there's a risk this gets cut off. So big problems are going to occur if this war with Russia is not resolved very, very soon, which is why I think that's the most likely outcome in the near term. Here's these bond markets we're following. I'm going to add in. So it's critical these stop crashing, and this will actually make the Fed much more interested in easing policy than stocks going down. These are horrifying to them. All three falling off a cliff today, all due to inflation. So we'll see what they have for us Wednesday. I'm going to expect most likely a relatively dovish meeting. Here's the Tesla to Ethereum comparison. They trade quite correlated. It's been very hard to outperform these two assets. And if we looked at this, perhaps it's telling us there's some upside in Ethereum relative to Tesla. If we get these energy costs down and yields fall, would be the catalyst. Gold sold off a good bit today. I'm definitely considering adding a silver position to our portfolios, especially if we get a pretty good sell-off here. But at this point, we've not made that move. Here's a leveraged look at the TLT with TMF and against the dollar. So we can see they're highly correlated. And the sell-off's been vicious, just absolutely vicious in the TLT. So on a leveraged look, you can see this beautiful support line here. I think it's very, very unlikely that yields fall any further for the remainder of the year, assuming we can get these energy costs down and supply chains fixed from Asia. So we saw a very similar start to last year with yields falling, and then they rebounded for the remainder of the year. Okay, so these are the alternative energy products, copper, uranium, and rare earth metals. We're very bullish on all three of these for the next several decades. They've all had some pain as of recently. If I zoom into this view, uranium's down 18, RMX down 15, while copper miners is up 13. If we zoom out a good bit, we can see that relative to peak pricing, uranium and rare earth metals are significantly undervalued compared to copper miners. So I do think we have more upside potential in lithium and cobalt from rare earth metals than we do in copper miners. This was the core inflation print of that came in below 6.5. This excludes food and energy. And this is the one we're paying more attention to, assuming that food and energy will come back down as soon as the war ends. And so this is what I wanted to see to predict that inflation is going to top off and fall, that this would be bullish for growth assets. So again, the big wild card is how much pain does the world want to take with this Ukrainian fight. We will get a new PPI, I believe, tomorrow. Rumors it's going to be above 10. We will see. And then we get the interest rate decisions on Wednesday. Okay, here's the balance sheet. The rumor is that they're going to let this roll off about $1 trillion a year, from 9 trillion down to 7 trillion over the next 2 to 3 years, while simultaneously hiking interest rates up to 2.5% to 3%. So I don't think any of that we're going to get anywhere near that without creating a lot of problems. So far they've done absolutely nothing hawkish yet except talk about it. So we'll see how the markets behave Wednesday. And perhaps the markets will like the idea that the Fed's getting a control of inflation. Okay, very good. So we're about to jump into the track records and the exact trade allocations. I'm gonna go ahead and India, if you're not a paid member, this is where your video ends. Call Dean to upgrade at 505-322-7515.